Welcome back to Market on Close. I'm Oliver Brannick. We're going to move away from equities, maybe for a moment, to talk to greenback and more with Mr. Scott Bauer, the CEO of Trading Academy. All right, Scott, we've got 10-year yields trying to push back to the upside. The U.S. dollar, meanwhile, flat today and still kind of flat over the course of the past week. So what are we to make of that epic rally?
Well, there's definitely some support because of the weakness in the yen. So that's keeping the dollar at least where it's at. It's afloat, in the 94.5 and up from there. So that's why we're up here. Now, why isn't it, back to record territory or back to where we were, 95.5, even approaching 96? There's a lot going on in the marketplace. The most recent news we got, CPI was up just 0.1%. So, that's putting some pressure on the dollar here. And I think, honestly, Oliver, it's the tariff talk flows into every sector of the economy, every sector in the marketplace. And the dollar is not, is not hiding away from it. So, there's so much talk every single day, as we know. Every day there's a new story. Every day there's a new it's on, it's off, it's on, it's off. That right now, I truly think, much like we're seeing in other parts of the marketplace right now, there's just a very undecided trade in the dollar. Yeah.
Hey, Scott, call me a simpleton, but I look at those economic surprise indexes a lot. Yeah, there was a lingering pause there that maybe I shouldn't have given you. All right, so back in February and March, there was a suspicious amount of weakness in the global economic data relative to our own. And then that quickly manifested into a dollar rally that basically extended while Eurozone data missed. Then China started missing. We know the story for what happened with EM data. Now, if I go and pull up all these city charts, who maintains these indexes, it's looking a little bit more like that old synchronized global growth story. But I guess that's not as favorable for the dollar.
No, it's absolutely not. I mean, people were flocking to the dollar because, like you said, economically in the EU, China, most other parts of the world earlier this year, quite frankly, it was dismal. The outlook was not great. But as we see things picking up a little bit, now we're starting to see a leveling off a little. But I don't think that really will hit the dollar that bad, because with this upcoming earnings season and with the economy the way that it is going, unless we get a full-out trade war, unless we start seeing the bottom lines of our multinationals start getting hit because of tariffs, the dollar is still going to be a place that people are going to put their money. And I could see us reaching those 96 levels that we were just at just a short while ago, sooner rather than later.
All right, so Scott, let's talk a little bit about bonds as well here, because the 10-year, again, these moves to the upside, I don't even know if we need to call them that until we get back to that 3% level, right? As long as we're below the high of the year, then nothing here looks too bearish, one could argue. We had a pretty interesting conversation this morning. Yeah, go ahead, Scott, jump in.
No, I'm sorry, but what I was going to say is, not only is it the 10-year getting back to 3%, what about the 30-year?
Yeah.
Right?
Now,
I mean, I agree with you.
Yeah, we basically got this flattening, right, that everybody's talking about. They're waiting for the inversion. Scott, are you like everyone else sitting here counting down the minutes until it happens before you just abandon risk and run for the hills? Or how do you see this sort of playing out in terms of the trading environment if and when this gap, inverts?
So I am never one to be part of the flock and never one to be part of the herd. But yes, I am in that camp. I think everybody's just got to, seriously, I think we just have to calm down. We have to let nature take its course. We have to let the markets kind of work itself out. We look back historically and maybe we get a little bit tighter than we are now. But I honestly don't see these yields becoming inverted.
Now, when we look at this, there is obviously this concern about the gap closing. And then we ask the questions of why, right? Is it because of the conversation about the economic data and the fact that some of the other central banks are moving slowly? We had a pretty interesting conversation this morning with Christina Hooper of Invesco, Scott, and they did a survey basically looking at sentiment. And it was pretty convincing, where something like 2/3 of people said, hey, this is a great bull market in January. Then suddenly things get rough and it drops to like 40%, and people kind of sit on their hands. I wonder just how much of the resilience of the bond market, especially in those 10 years, has been about fear, about sentiment related to tariffs, and really nothing about this kind of sophisticated, bond market economic analysis we do.
Well, one of the best indicators that we can, really track and follow over time is really sentiment, consumer sentiment. Whether it is at its high point or low point, it is typically an inverted relationship to what happens in the market, right? When we get overzealous, over bullish on the marketplace, that's usually a time that we see a sell-off. Other side is true as well. When we see increased fear and people, flocking out of the market, that's usually a time you want to get in. So, I look at that consumer sentiment, and I'm not sure about that exact research that you're referring to, but if people are getting a little overzealous and a little uptight about this inversion, about what's going on with yields here, again, I say slow down, take it in stride. I totally believe that they're going to widen out in the next coming months here, especially if we get an abatement on the tariff talk and if earnings can produce even, just a marginal increase. I'm not saying we need blowout earnings, but I'm saying if we can get just a marginal number here, which really is the backbone to what is going to drive this market, then we know for sure the Fed is going to raise 2 times. And then, you know what? We're going to widen out. Scott,
last point here is that the irony of all this kind of fear that has now seeped in with the tariff stuff, when we talk about just getting a marginally good number, all things considered, lower than Q1 expectations, but as we talked about when you're on the panel here, still 20% growth, and people are shaking a stick at
it. 20% growth is really good, right? Over the course of time, we would take that all the time. And the bottom line is the 20% growth really coming because, that's the bottom line? Revenues are great. Is it coming because CapEx has been pulled back? What is it really coming from? So if we see revenues increasing and the bottom line increasing, fantastic. The one other driver that I want to bring up, Oliver, which I really see as something that I think is going to pick up, which has really dragged on the marketplace, is wage growth. We look at all the great economic reports that we've seen, yet wage growth is still lagging. We really haven't seen it tick up. If we start to see that tick up as well, meaning that consumers are now going to have more, more discretionary income, I think it's off to the races.
All right, there we go. Great stuff, Scott. All the way from the U.S. dollar back to equities, setting us up for our next conversation. Scott Bauer joining us, CEO of Prosper Trading Academy.